After the pandemic, new business applications soared to record-breaking numbers. And it's important to note that if you're self-employed and you're going through the mortgage process, it's going to be different for you than a standard W-2 traditional employee. Now, this doesn't have to be a bad thing, but knowing the scope is going to help you navigate this process. So what do you need to know? First of all, if you're self-employed, generally, and this would be for FHA, VA, USDA, Fannie Mae, Freddie Mac, and jumbo loans, full income documentation loans are going to require that you've been self-employed for 2 years and have 2 years tax returns. Now, there are some exceptions to that, but if you go into this thinking 2-year tax returns, that's going to be a great start. The thing to keep in mind, though, is that lenders are going to average your income over those 2 years. So let's say that first year of being self-employed, you showed a loss. Well, that loss very well is going to be calculated into that average over the 2 years. It's just one of those things when we talk to self-employed borrowers, and this is a real niche for us. We talk to self-employed borrowers, they're always like, yeah, I made $500,000 last year. Well, they're thinking gross receipts, not net, after all of the deductions and itemizations. From a lending perspective, again, full income documentation, lending perspective, it's net income. It's not gross income that lenders use to meet the lending guidelines for the income calculation. So that is just like setting the story straight, making sure that you know that. So if you are self-employed and you want to purchase a home, and maybe you're newly self-employed, talk with a lender, kind of better understand what they're looking at on tax returns, better understand your structure, if it's a sole proprietor, if it's a C Corp, an S Corp, if you get distribution income, there's so many different variables. Be sure to get the insight you need. That way, as you start to prepare your tax returns, you're going to be set up for success to be able to qualify for that home loan when you're ready to buy. Now, let's say that that's not the case. Maybe you've been self-employed for years, and you might say, you know what? Tell me more about non-qualified or non-traditional types of mortgages. And those are not the programs that I spoke about. But there are non-qualified mortgages out there specific for self-employed borrowers who maybe in lieu of using a traditional tax return to qualify, maybe they're using bank statements to qualify. So it's a completely different approach. And in that scenario, you would be providing 12 or 24 months of personal or business or potentially both of your average bank statement deposits. And that could be used to calculate income. So a different approach. It's going to require more down payment in many cases. Interest rates on those are a little bit higher, but many times it is a valuable solution to maybe not being able to meet the traditional mainstream full income documentation with a tax return type of lending guideline. If you're self-employed, I hope this painted a clearer picture of the process of getting a home loan. And don't be discouraged. There really are solutions out there. If you'd like to dive into this deeper, click the link below to schedule a personalized consultation with a KellyZtilowGroup mortgage advisor. And don't forget to subscribe to this channel for more valuable mortgage education.